I hope guys you all have understood this. So have you noted down this much in our previous class? Done guys, noted down this. Mishika, Drishti and Avi. Done right? Three of you, Avi, Mansha, sorry, Mishika and Drishti. Mansha, Anish, Manya, have you noted down this?
Yes, sir.
Yes, sir.
So guys, starting with liquidity ratios, these ratios are used to determine short-term solvency position of a business. That is to know whether a business can repay its short-term liabilities, that is current liabilities on time or not. So these ratios are used to determine or evaluate short-term solvency position of a business. Short-term solvency position is capacity of the business to repay its short-term or current liabilities. So I hope guys you have understood why do we use liquidity ratios in our analysis. There are following two liquidity ratios. There are many guys, but you have only two in your syllabus. The first one is current ratio. Then guys, note it down till here. All
Yes, sir.
current ratio guys is ratio of current assets to current liabilities. So current ratio is equal to current assets upon current liabilities. So in this ratio, guys, in numerator also we have group of accounting variables, and denominator also we have group of accounting variables. Not only one item in numerator and denominator, but more than one item. So in current assets, you must know what items fall: cash in hand, cash at bank, checks in hand, debtors. Here you have to take debtors net of provisions. So if the business has made any provisions for doubtful debts or for discount on debtors, they should be subtracted from debtors, and the net amount of debtors should be taken here. Then bills, receivables, inventories, that is stock. You know that stock may be of different types. It may be stock of raw material, finished goods, work in progress, goods in trade, and stores and consumables. Short-term investments, short-term or current investments. Prepaid expenses, accrued incomes, advance tax, short-term loans and advances that the business has given. We have to pay tax to the government in advance before the year ends, income tax. नहीं, हम रिकॉर्ड ईयर के एंड में करते हैं, बस पे हम ईयर के बीच बीच में करते हैं हर क्वार्टर के बाद. So that is advance tax. So in case the tax that our tax liability as per our calculations is lesser than what we have already paid, then there would be net advance tax, and that will reflect in our balance sheet as an asset. आप अगर आपने ज्यादा दे दिया तो एडवांस टैक्स आपकी एसेट हो गया, राइट? Current liabilities include creditors, plus bills payable, outstanding expenses, unearned incomes, that is, incomes received in advance, provision for tax, provisions made for other expenses, short term borrowings, that is, bank overdraft, and bank cash credit, including current maturities of long term debt. This, guys, we have recently discussed in our previous class, in one of our previous class. The portion of long term debt which is getting due within 1 year from the date of balance sheet actually is a current liability. And that is why that also would be considered here. Got this, Anish, Mansha, and Manya?
Yes, sir.
Unclaimed dividend, unpaid dividend, calls in advance, interest accrued and due. This I will explain you in debentures chapter. Interest accrued but not due. They all are part of current liabilities, guys. वो एसेट है, लाइबिलिटी नहीं है बिजनेस का. एसेट है वो, लाइबिलिटी नहीं है. वो कैपिटल का पार्ट है, इसलिए करंट एसेट्स में नहीं लेते हो. दैट इज पार्ट ऑफ कैपिटल. कॉल्स इन एडवांस इज नॉट पार्ट ऑफ कैपिटल, राइट? वो एसेट का पार्ट है लेकिन करंट एसेट नहीं है. लिख लिया आपने तब? Done, guys? Have you all noted down this much?
Yes, sir.
Here, guys, noted down this. Done, Mishika? Drishti, noted down? Shh, guys, please. So, guys, suppose current assets of a business are 1,20,000 and its current liabilities are 50,000, then its current ratio would be 1,20,000 divided by 50,000. That is current assets divided by current liabilities. That is 2.4 times. Or you can also write it as 2.4 is to 1. Have you got me guys or not? Or you can also write it as 12 is to 5. But when we write it like this, it gives us clear picture that current assets are 2.4 times of current liabilities. Right? Now guys, ideal current ratio. This is sometimes asked in Viva, what is ideal current ratio? So ideal current ratio is said to be 2. That is, current assets should be twice of current liabilities. Right? Then the next question arises why it is so? Why it should be 2? Why it should not be lesser than or more than 2? Now, guys, why current ratio is said to be why ideal current ratio is 2? Because even though suppose here we have current liability is 60, then our current ratio would be 2 or 2 is to 1. Now, suppose one fine day we suddenly have to close down our business, and in that case, we have to pay off these liabilities in one shot in one go. We will recover money from our current assets. Even though half of the current assets could be realized, then also we can repay all our current liabilities. That is why it should be at least 2. Am I clear or not? Because you know that recovering or realizing money from current assets, that is by selling stock or by recovering it from debtors, is a difficult task, especially when they know that now your business is going to get dissolved. So they do not pay on time. They do not pay full money. But even though we get half of it, then also we would be able to repay all of our current liabilities. Am I clear? So it should not be lesser than 2. Now the question is why it should not be more than 2. It should not be more than 2 because if it is more than 2, it means we have more current assets, and that is unnecessary usage of money which is blocked in current assets. A wise businessman or a wise management tries to maintain its current assets as low as possible. I hope you're understanding this, guys. Suppose you have too much of stock in your business, but you are able to sell very less. Think of the other business which has very less stock, but it is able to sell more. Which business is better? The first one or the second one? Second one. It means a business should not block its money, should not invest its money much in current assets. And that is why current ratio should not be more than 2. I hope you have understood, guys. Why I'm explaining you and sharing this with you because this is also asked in Viva. Got me, guys, or not? You can note down this, guys. Note down this much, guys, all fast. Mishika, note it down this much. So, guys, this is how we are done with liquidity ratios. You have only two liquidity ratios in your syllabus. The next one is solvency ratios. Okay, guys, liquidity ratios are used to determine capacity of a business to pay off its short-term or current liabilities, whereas solvency ratios are used to determine capacity of a business to pay its long-term liabilities. So guys, current ratio is mainly, sorry, liquidity ratios are mainly used by those who have to recover their money from your business within 1 year. That is your lenders who have lent you short-term finance, whether it is bank or some other financial institutions or any other individual. Then your creditors, your employees, in case you yet have to pay them their salaries or wages, and other suppliers of services. They all are interested to check, to evaluate your liquidity position, right? On the other hand, those who have given you money in long term, for long term, like you have taken a long term loan from bank, they would like to check your long term solvency position, that is capacity of a business to repay its long term liabilities. So these ratios are used by those who have provided long term funds to the business, be it lenders or shareholders, that is owners. In lenders, we also have debenture holders. Debenture is also a debt instrument, means the instrument through which a company raises long term funds. Hmm? Right. In America and Europe, no one knows debentures. They call everything bond, whether it is by government or by any company. They call it bond only. इंडिया में बहुत कुछ होता है. Current ratio of a company is 1.5, that is 1.5 times or 1.5 is to 1, and its working capital is 1,25,000. We have to calculate current assets and current liabilities. Have you noted down this much all? Mansha, Anish, Manya, noted down this.
Yes, sir.
Current ratio is current assets upon current liabilities, and that is 1.5. So current assets is 1.5 times of current liabilities. From this equation, I have shifted CL to the right hand side. So now it has become 1.5 CL. Correct or not? And working capital is current assets minus current liabilities, that is 1,25,000. So in place of current assets, we can write 1.5 current liabilities minus current liabilities is equal to 1,25,000. So zero point 0.5 current liabilities is equal to 1,25,000. So current liabilities is 1,25,000 divided by zero point 0.5, that is 2,50,000. This is how we have determined current liabilities. Have you got this, guys, or not all? I'm asking again. Drishti, Mishika, have you understood this? Current ratios formula is current assets upon current liabilities, and the value of current ratio is given to us as 1.5 that I have taken here. So by shifting current liabilities to the right hand side, since current liabilities is getting divided here on the right hand side, it will go and will multiply with 1.5. It means current assets are 1.5 times of current liabilities. We have been given working capital, which is current assets minus current liabilities, and that is 1,25,000. In place of current assets in this equation, we have kept the value of current assets, that is 1.5 current liabilities minus current liabilities is equal to 1,25,000. 1.5 current liabilities, and current liability means one current liability. So 1.5 minus 1 is zero point 0.5 current liabilities is equal to 125. So current liability would be 125 divided by zero point 0.5. That is 2,50,000. Got this? Guys, do not do the mistake of solving such questions by taking X and Y. You will waste your time in exam and you will not have that much of time. I hope you all have got this. Right? Note down this much, guys. So here, guys, current assets would be 1.5 current liabilities, that is 1.5 into 2,50,000, that is 3,75,000. So now we have got both current assets and current liabilities. Are you getting this, Mansha, Anish, and Manya? I'm asking Anish, Mansha, and Manya.
Yes, sir.
Anish, Manya, are you getting this?
Yes, sir.
Done, guys, all? Note it down, Mansha, Anish, Manya, Mishika, Drishti, Avi, Manvir, Devansh. Manvir, Devansh are busy in mobile always. I do not know what do they have in their mobile and what they can't see after the class in the mobile. Your parents snatch your mobile as soon as you enter the house. Then, okay, guys, if in this question, that is an example one, we have also been given quick ratio as 0.8 and we are asked to calculate stock, then how to calculate stock, let's see that. We have already calculated here current assets and current liabilities. We know that quick ratio is equal to current assets minus stock divided by current liabilities, and that quick ratio is given to us as 0.8. Quick ratio is nothing but it is liquid assets upon current liabilities, and liquid assets are current assets minus stock minus prepaid expenses. I have recently explained you that, guys. Here, liquid assets are current assets minus stock minus prepaid expenses. Since in this question we do not have any information about prepaid expenses nor any illiquid current assets, and that is why we assume that there is only stock that we have subtracted from current assets. Are you getting this or not, guys? So, current assets which we have already calculated is 3,75,000 minus stock upon current liabilities, that is 2,50,000, is equal to zero point 0.8. So 3,75,000 minus 250, sorry, minus stock is equal to 0.8 into 2,50,000. This 250 which is getting divided here, that now has got multiplied with zero point 0.8 by going to the right hand side. And that would be equivalent to how much? 10 lakhs, sorry, 2 lakhs. So stock would be 3 lakh 75 minus 2 lakhs, that is 1 lakh 75. I hope, guys.